The fix everyone is waiting for would bankrupt the system. That's the contradiction hiding in plain sight. The story people keep repeating sounds simple. Inflation got out of control before, so it can be crushed again the same way. Raise rates hard enough, restore confidence, move on. It worked once, so it should work again, except the math no longer works. In the early 1980s, the country could absorb pain. Debt was manageable. Today, debt is the system. Trillions piled on top of trillions, larger than the economy itself. Push rates high enough to truly stop inflation now, and the interest bill alone overwhelms the state. This isn't theoretical. This determines what happens to your money. Your savings don't lose value by accident. Your income doesn't fall behind randomly. If rates were forced high enough to protect purchasing power, the government couldn't pay its own obligations. That option isn't controversial. It's off the table. So here's the question most people never ask. If the only cure would collapse the patient, what path is left? And what does that quietly guarantee about the future value of cash? Because once you understand the trap, the rest of the story stops being confusing. What's happening now isn't a single policy failure. It's the exposure of a larger pattern that's been forming for years. Rates didn't stay low by accident. Debt grew faster than income. Deficits became permanent. And gradually, the role of monetary policy flipped. Instead of disciplining the system, it started protecting it. Inflation became something to manage around, not eliminate outright. The core event isn't just rising prices. It's the moment debt began dictating policy instead of the other way around. When interest costs grow large enough, they stop being a side effect and become the constraint. Every percentage point matters. Every move ripples through budgets, markets, and political pressure. Watch how the language changes. Officials still talk about fighting inflation, but always with qualifiers. Gradual, data-dependent, flexible. That caution isn't weakness, it's necessity. And here's the reframing question that shifts the lens. What if the real objective isn't price stability at all? What if the priority is keeping the system solvent long enough to roll the debt forward? Because once servicing the past determines choices in the present, the future starts getting shaped in very specific ways. And those ways rarely favor people holding cash. The strongest claim you can make here is this. The system now depends on negative real returns to function. Look at the numbers beneath the headlines. Nominal rates rise, but never far enough to outrun inflation as people actually experience it. Even after tightening cycles, cash still loses purchasing power in real terms. That gap isn't a rounding error, it's the mechanism. Here's why it matters. In the early 1980s, holding cash paid you to wait. Rates were pushed above inflation, and money flowed out of hard assets back into the currency. That's what crushed gold and restored confidence. Today, that condition doesn't exist. Rates can't go high enough without detonating debt service across government, housing, and corporations all at once. Notice what's missing from official reassurance. There's no promise that savers will be made whole. No commitment to restore positive real yields. No language about cash becoming a safe asset again. That silence is the tell. This is where the story flips. Cash isn't being protected. It's being sacrificed. Quietly, mathematically, and by design. When holding money guarantees loss, people are forced to move. Not because they want to speculate, but because standing still becomes too expensive. And once capital starts moving defensively instead of opportunistically, the system enters a very different phase. What follows is escalation, not correction. Once negative real returns become permanent, distortions spread fast. Markets stop pricing growth and start pricing dilution. Assets rise not because the economy is suddenly healthier, but because money itself is worth less. That's how stocks and gold can climb together without canceling each other out. There's a historical parallel people miss. In past tightening cycles, pain was intentional. Recessions were tolerated. Defaults were allowed. That pressure restored credibility. Today, the tolerance for pain is gone. Every tightening attempt runs into the same wall: debt fragility, market stress, political pressure. So discipline gets softened before it can work. What should be extraordinary becomes routine. Emergency liquidity stays in place. Balance sheets never fully unwind. Rate cuts are discussed while inflation is still present. Over time, this trains markets to expect rescue, not restraint. And here's the dangerous part: normalization dulls warning signals. When people stop reacting to rising debt, shrinking real returns, and permanent intervention, extremes stop looking extreme. This is where instability quietly builds, not through panic, but through complacency. And systems that rely on complacency don't fail slowly. They fail when something finally forces reality back into view. The next proof is harder to ignore because it shows up in behavior, not rhetoric. While public debate focuses on whether markets are overvalued, the most powerful players aren't arguing. They're repositioning. Central banks are accumulating gold at a pace not seen in decades, not trading it, not hedging it, acquiring it outright year after year, regardless of price. That matters because central banks don't chase momentum. They plan for survival. When institutions responsible for currency stability move away from paper reserves and toward physical assets with no counterparty risk, it's a signal, not of optimism, of precaution. Here's the contradiction that changes how you read the situation. These same institutions publicly defend the strength of the system while privately diversifying away from its core liability. Words say confidence. Balance sheets say anxiety. Notice what isn't happening. They're not increasing exposure to long-term bonds. They're not doubling down on fiat promises. They're choosing assets that don't rely on anyone else's ability to pay. That single shift reframes the entire story. This isn't speculation at the edges. It's risk management at the center. And when the center starts hedging itself, it tells you something fundamental has changed. Because institutions don't move early by accident. They move early because waiting is the real risk. Now the pressure starts stacking fast. First, regulation quietly changes incentives. Gold is no longer treated as a fringe asset inside the banking system. It's being reclassified, elevated, and normalized as core collateral. That doesn't grab headlines, but it forces behavior. Banks respond to rules, not opinions. Second, geography fractures the response. While parts of the global system move forward, others delay. Compliance advances in some regions, stalls in others. That gap creates arbitrage. Physical assets get pulled toward where rules reward them, draining supply from where leverage still dominates. Third, leverage becomes the stress point. Paper claims stack on top of limited physical inventory. The system works only as long as confidence holds and delivery is rare. But confidence isn't a constant. It erodes under pressure, especially when large players start acting defensively. These developments don't explode on their own. They compress risk into fewer, tighter points. That's when small shocks start producing outsized reactions. What happens if this continues? If physical supply tightens, leverage remains high, and trust keeps thinning at the edges, because when pressure stacks without release, systems don't adapt gracefully. They slip, and once they slip, control disappears faster than anyone expects. At this point, the consequences stop living on balance sheets and start showing up in the real world. You feel it when prices don't line up with explanations anymore. When official numbers say things are improving, but your expenses say otherwise. When volatility leaks out of markets and into everyday planning. This isn't about trading strategies, it's about uncertainty becoming a constant. Supply tightens in places people don't expect. Costs fluctuate without warning. Long-term planning gets harder because reference points keep shifting. Even institutions start acting short-term, prioritizing flexibility over commitment. That behavior trickles down. Employers hesitate, consumers delay, everyone stays reactive. This is how financial stress becomes social stress, not through collapse, but through friction, more effort for the same outcome, more risk just to maintain position. Over time, that changes how people behave, what they trust, and what they avoid. If this feels familiar, say so in the comments. Because when millions experience the same pressure at once, it stops being anecdotal. It becomes structural. And once stress spreads beyond markets into behavior, the system enters a phase where feedback loops accelerate. At that point, momentum matters more than intent. Once you step back from the noise, the mechanism becomes clear. This doesn't persist because no one sees the risk. It persists because the incentives reward delay. Debt-heavy systems survive by stretching time. Inflation spreads losses quietly. Liquidity smooths stress just enough to prevent breaks. And spectacle keeps attention fixed on surface moves instead of structural drift. The leverage here isn't just financial, it's psychological. As long as conditions feel manageable, people adapt. They accept erosion in exchange for continuity. That buys the system room to operate without making explicit choices that would force confrontation. What makes this dangerous isn't greed or incompetence. It's optimization. Every actor is behaving rationally within constraints. Governments prioritize solvency. Markets chase protection. Institutions hedge silently. No one pulls the fire alarm because the building isn't on fire yet. This is why mainstream coverage feels incomplete. It focuses on events, not incentives. But incentives are what determine outcomes. And here's the unsettling insight. Systems don't fail when everyone is wrong. They fail when everyone is right too late. When the logic is sound, but the timeline runs out. From here, attention shifts from causes to trajectories. Because the next phase isn't about what already happened. It's about what the structure now makes inevitable. From here, the future narrows into two broad paths. One path is slow fragmentation. Trade reroutes, settlement systems diversify, reserves shift quietly from promises to physical backing. No single announcement marks the change. It unfolds through infrastructure, regulation, and behavior. Over time, reliance on one dominant currency weakens, not because it collapses, but because alternatives become usable. The other path is faster adjustment. Confidence breaks somewhere specific. A delivery failure, a liquidity shock, a geopolitical move that accelerates distrust. In that case, responses become visible and urgent. Support expands, controls tighten, the currency absorbs stress to protect the system. Both paths point in the same direction. Reduced dominance, more fragmentation, less tolerance for leverage, built on trust alone. The difference is speed, not destination. And this is why positioning matters before outcomes are obvious. Systems move on incentives long before headlines catch up. By the time changes are formally acknowledged, most of the adjustment has already happened. The next move won't be debated on television. It will be implemented quietly through balance sheets, rules, and settlement choices. And once it's in motion, reversing it becomes almost impossible. Here's the frame that makes the entire story click. This isn't a cycle repeating, it's a system aging. When debt was small, discipline worked. When debt became dominant, time replaced discipline as the primary tool. Inflation, asset inflation, regulatory shifts, and quiet repositioning aren't separate events. They're coordinated symptoms of a structure trying to survive its own scale. That's why nothing feels resolved, why every solution creates a new constraint, why confidence is maintained without being restored. The system isn't broken in the dramatic sense. It's constrained in a way that forces gradual change instead of clean resets. Once you see that, the noise fades. Market swings, policy speeches, short-term data points, they matter less than the direction incentives are pulling everything underneath. Toward fragmentation, toward tangible backing, toward risk management over growth narratives. This is the layer most people miss because it doesn't announce itself. It unfolds quietly until suddenly it's obvious in hindsight. If you want to understand what comes next as this process deepens and how power and money adapt when old rules stop working, follow for the next breakdown, because the most important shifts don't arrive with a crash, they arrive with a new normal.